All right, everybody, I'd like to introduce our next keynote presentation here at the Planet MicroCap Showcase Vancouver. Up next is Neil Reithinger from Eventus Advisory Group. He'll be giving a presentation on going public in the U.S., a financial perspective for Canadian issuers. Neil, take it away.
Thanks, Robert. Most of all, thank you for getting my name correct. Really appreciate that. Eventus is a management consulting firm. We're an outsourced CFO firm. We are not an audit or assurance firm. We are an extension of a company whereby we'll do all the internal accounting, financial operations, SEC compliance, and so on for U.S. companies or FPIs going public in the U.S. and so on. It's a gap with a lot of companies have. They need help with. So we specialize in that, and we're kind of like that fourth leg of the stool, if you will. When you got the auditor, you got the legal counsel, you got the banker, and if that piece is not fulfilled by the issuer, that's what we're here for, okay? I'm an SEC GAAP guy. I've been doing this since 1992. I think my first 10K I FedEx to the SEC, so it's been an interesting evolution, and I'm really, happy to be a part of the community of the small cap and the micro cap market as well, because there's a need for that. I think, as Brent said, companies are looking where the puck is going as they get bigger. That's where we are now and what we're here for, okay? Just a quick on the agenda here. I'm going to go through these areas. I do want to mention that we give little references at the bottom of some of these things with an E behind it. That means it's our opinion, because my opinion, sometimes I'm wrong, sometimes I'm right, but this is what we see from issuers, from our clients, and so on. Also, at the links page, there is some footnotes where I think are very helpful, because a lot of the fact areas are linked to something. You'll see that as well throughout the presentation. Okay. So market outlook, I just want to go over a few things here. Obviously, the nano cap, micro cap, small cap market is what we're talking about here. Look how many companies are in there. It's about 5,000 companies. Yeah, and so obviously as companies migrate, come in and out, they get larger and so on. There's a huge market for these smaller companies, which are clearly defined here with respect to, these particular categories. There's a thing called Stock Analyst, which is really a great site to go to, and you can do all kinds of pivot tables on what you see there in terms of, how you want to, analyze different companies, size, and complexity. As far as our view here on the market, different bankers, different investors in this arena we're in with respect to the microcap. Large cap has fundamentally different drivers and valuations, right? Interest rate environment is immeasurable. We've seen that very widely, especially too. We worked on a lot of SPACs. And of course, when the interest rates were different and interest rates were lower, the SPACs market was booming. Obviously, a lot of other factors at play there and so on. Valuations have come down significantly. Fundamentals, as Brent was saying earlier, you look for these companies, they got to execute, right? But the small funds are clever in terms of how they're going to bring money into some of these entities, okay? Now, this last one here is really important. Joe Lukowski at his presentation talked about this, but basically this 15 million public float for some national exchanges is very important. And what happens is if that's not a large enough raise and it's a smaller raise, 5 to 10 and not up to that level, there's existing shareholders that'll be a part of that. And although that's the reality of the marketplace, the issue is that does put potentially downward pressure and creates a lot of volatility, because if there's early investors that had cheaper stock and an IPO comes out at $4 or $5, that creates a lot of volatility there. So it's a very important point that comes up a lot. Bottom line is be pre-IPO ready so that the company is poised when the timing is right. You cannot control the timing. It just won't happen. So therefore, you got to be pre-IPO ready. Key leadership, bankers and underwriters. Understand the banking team that you might look for. Identify their distribution. There's institutional, there's syndicated, there's retail they have. Not a lot of bankers have retail. Very valuable, okay? Proactive to market fluctuations. Obviously, what you think you could do a deal-wise, 4 months ago, 3 months ago is different than it is today, okay? Focus on data, just like your favorite, MLB baseball player. You have data on bankers. What have they done? What kind of deals? What, in terms of finding out some of the track record, but also new IBs emerge. So even though you may not have heard of a bank, just because they have no tracker doesn't mean that it's better than a below average one. You have to have some of these bankers have migrated and moved around to different banks. So don't judge a book by its cover with respect to a name you haven't heard. Pick up the phone, contact, other issuer CEOs, make sure you talk to them. How did it go? How did the leadership occur? What was the timing? Get referrals, and see what their experiences are. And manage expectations. Best efforts is the deals here that, we've seen, and that's it mostly in terms of what we've dealt with. Having, managing expectations appropriately is essential to everything we do, right? Independent auditors. Obviously, PCAOB firms is what's required. Size and complexity. Larger firms, when you're choosing one, International operations and or significant number of transactions will narrow the scope of some audit firms. Can it scale with growth? Sometimes it doesn't matter because growth will be long-term, and a lot of these smaller firms can actually scale for quite a long time before it gets much bigger. And that's a good problem, right? Optics, some smaller audit firms they're suitable in many cases. Matter of fact, most cases. But sometimes, investors want to see someone else on the book. That can happen, okay? Timing and bandwidth, this is a big issue with respect to the accounting profession. We've got 300,000 people that have left the accounting profession. No one wants to do accounting. I don't know why it's so exciting, but that is actually a real number. So, and in that regard, there's resource constraints at all levels, the big four and even smaller firms and what have you. So make sure they have the bandwidth to be able to execute and be able to, perform timely audits and so on. Interplay on accounting issues. Accountants are independent, so they can't, by nature, they have to, can't collaborate. But there should be an interplay there where they can discuss technical issues to get through them. It's not a wall that you can't navigate around or navigate through. So there is feedback, and some firms are more strict about that than others. Okay, industry and others. There's certainly some auditors do not want to do certain industries. So you can ask them that and make sure that if they don't, they should professionally represent that. Okay. And price. And price is always a factor in everything we do, but don't let that be a driving factor. Okay, because a lot of times the right firm may be a little more expensive and the right firm may be smaller and they may be more expensive. It just depends, but they might be a best fit. From SEC counsel is what we see, size and complexity as well. And there's geographical reach. And of course you want the firm to have the same scope to be able to handle that. There's no bandwidth issues we've seen, by the way, in law firms like audit firms. So I think they're fine there. Optics, who do investors want to see? There's a great leadership with some smaller firms. Okay. Tax matters, there are some material tax issues that come up, so you got to be prepared. Some firms don't have a tax department to be able to do that, so you got to make sure you look at that as well so that they can, be able to opine on certain U.S. and Canadian transactions, okay? Again, leadership in the listing process, the firm has to have a depth of experience, S1, F1, whatever it may be, generally the same process so that they can lead that in the interaction up through exchange and through the IPO. I mean, it's a very proactive process, and that leadership needs to be there, okay? And then, of course, price as well. Again, another factor. Some larger firms can be much more expensive, but sometimes that's needed depending on the complexity with regard to what I mentioned above, tax matters, international and so on, okay? And then which is what we are, the issuer and or consulting accountant. Sometimes companies have what we do, and they don't, like big companies, we weren't exactly involved in the Kava IPO, right? Because, that's a big, large IPO that was done by big underwriters, but there are many companies, as you've seen, like I pointed out with the numbers there, that need that leadership and planning. They shouldn't be reactive to the process of timelines or audit requests. Implement a schedule for every filing with delineation of duties. Again, if this is not happening internally at the company, a consultant needs to come into play to help do that because the auditor needs to rely on that to make sure that it can meet its audit timeline if the company is responsibly doing its piece. Technical accounting issues and material transactions are identified early. Okay, we want to make sure those are, because those can be a drag and require some technical analysis. And then determine if valuations are needed. If a company's doing acquisitions and so on, and you have to be able to do either, business combination or purchase price accounting, you got to be able to, have those financial instruments or technical accounting details mapped out. Tight financial operations, access to data, and the financial statement prep kept current to avoid stale periods. This is a big deal, because the stale periods can creep up if you don't have your processes in place. You're holding up the timeline, okay? Again, build financial operations is the key here, not just for the IPO, but post-IPO, because a lot of times the IPO is not the goal in itself. The goal in itself is to perpetuate the successful company once it receives its funding, okay? Regulatory pathways here, we have the Securities Act of 1933, which is for domestic issuers or foreign private issuers. So that, S1 domestic, F1 obviously FPIs. 33 Act registers specific securities for public sale, right? In the comment period, usually about 30 days for each turnaround, right? So once that F1 is filed or that S1, there's usually a turnaround. Typically SEC would be sooner, but cleared and then can be declared effective. So on the FPI side, this is a very, there's a lot of scaled down disclosures for FPIs. And under the typically, these are applicable unless these factors here, more than 50% outstanding voting securities, are owned by or record by U.S. residents, and any of those following apply. Okay. So these are bright line measurements. Okay. So, but the key benefits here is that you have the ability to report under U.S. GAAP, IFRS, local GAAP. Your quarterly reporting is not required, and due date for the annual report is longer. Okay, 120 days as opposed to 90 days. And the financial information goes stale more slowly, right? Because the reporting period is longer, that financial information will be in the actual reporting of any interim period, which is required by the exchanges. You have a longer period of time of which you can report your, include numbers in a registration statement, okay? Eligibility here, the test for compliance is beginning after the January 1st, 11, that's when this came into play. Test for compliance is required to be performed the last business day, okay, of the resident's most recently completed fiscal quarter. And if no longer eligible, then things start going to GAAP, okay? You recast into GAAP for all periods. You must use the US dollar as a reporting currency unless another functional currency, the business, in other words, operates in a currency that is more relevant and appropriate, okay? So a Canadian company that is not a foreign private issue must use US GAAP in filings with the SEC, okay? And on interim reports here, this is important. There's no SEC requirement for an interim report, right? But there is an exchange requirement. So just because, you know, there's two masters to serve here. You've got the SEC as a baseline, but then the exchanges have their own baseline, which they, on the heels of what the SEC is. This is a requirement for an interim, which is 6 months semi-annual. So you have an annual and semi-annual, okay? So that's an exchange requirement. The Rule 15250 is not SEC, it's a NASDAQ rule, okay? And then same here for corporate governance. They need to, if there's certain rules in the home country that could supersede what's required on the exchange here, so that is important as well. So there's an interplay between what's accepted or required in the local exchange as opposed to what could be required for an SRO, for a national exchange. Now, if you look up this, you might see this chatter out there about, drawbacks of being a U.S. domestic issuer or the pros of being an FPI. And I don't think, personally, that's not something we recommend following. Yeah, it's true. Follow the rules, compliance, exchange rules. But when you see certain executive officers subject to greater personal liability with respect to their certifications or increased risks being subject to negative consequences with the file, when you're public, taking investor money, follow the rules based on the exchange and or in terms of the requirements that are the strict letter of the law. But bottom line is you're subject to greater personal liability either way. So when I see chatter like this, it doesn't really faze us because we want to make sure that at least with our clients, they look at what their requirement is and that they behave with a fiduciary responsibility either way. Okay. So anyway, with respect, I think the key here is that FPIs, regardless of your reporting requirement, we can do that. It would behoove you to the bankers can drive this is what is the frequency or the manner in which you report that's going to be best for your capital raising process, right? Because you don't have to fall. You can escalate your plan or increase your level of reporting depending on what you feel is going to be best from a capital markets perspective. So that's a key takeaway here, okay? Other paths, there's Reg A, which is open to Canadian companies. Form 10 is a 34 Act registration statement. It does not register something for public sale. You've probably seen these when you see companies that have registered on a Form 10. That's another, they can raise money later on a registration statement. A 20F is kind of the equivalent of that Form 10 for FPIs because that's a 34 Act statement that is for registration, not for public sale, okay? And then reverse takeovers, RTOs, reverse mergers, shells. Everybody's heard about all those. The reverse capitalizations, reverse, the reverse mergers that come in some different accounting treatment. But at the end of the day, there's really aren't any shells anymore, okay? Because the new shell rule is such that companies that do not have operations, certainly companies that don't report their information, but companies that do not have operations, regulators don't want that. Okay, so all those companies are pretty much gone, and any company that has minimal operations can actually be technically deemed a shell because it doesn't have, that doesn't meet the requirement. So that was a very popular thing for many years, but technically speaking, it's not really applicable anymore. Okay. And then navigation of registration statement. There's an S1, F1. DRS or live filing. DRS is draft registration statement. Many of you have probably heard about this. Very effective, because what it does is it's not a complete registration statement in the sense of you can flush out initial comments. You can actually leave blanks for certain financial information, and then you can include the rest about the business and to flush out SEC comments with respect to the business, with respect to the key factors in terms of what the company's business plan is, capital raising, what it intends to do, use of proceeds, and what have you. But it doesn't have certain financial information, doesn't have pricing information, and what have you. And then once a live filing, after a substantial amount of those comments are cleared, then a company can live file, okay? And then it's cleared and continually updated until it goes effective, all right? The DRS does become visible on a live filing, okay? So if you're looking for that as a flyby or a practice test, it'll show up later, okay? So you want to be aware of that. Only areas that can remain blank are those final pricing or price range. In other words, after you live file, that's to the last minute until the company prices, okay? Because sometimes that changes. Need a banker on the book, or likely SEC will not review the filing, okay? We have not seen any registrations kicked back because there's blanks, because SEC knows and expects that the issuer will know that. But if there's no banker on, they will kick it back, because sometimes during the filing process that is left off because you don't have a banker, right? So audit requirements, comment periods, SRCs, small reporting companies. There's scaled down requirements for them. These are what in general companies qualify as an SRC if one of these four factors. Okay. Most of the companies we're talking about in the tier that we're discussing with the microcap fall into this category. It's beneficial. Okay. Less extensive narrative disclosures, such as when you do qualify, like executive comp. And the audit financial statements are 2-year period, not for 2 fiscal years, in contrast to other larger companies where you'd have 3 years, and so fiscal years, and also, but you are required to have the latest interim period as well. Okay. Expected SEC response time, I mentioned this earlier, is about 30 days with each submission. Okay. Typical response time is sooner. During the SPAC boom, it was definitely 29 or 30 days because they need all the time they can get. So. Plan for 3 rounds of comments on an S1. 30 times 3 is 90. Simple math. I can do that myself. Not including turnaround time from issuer. Okay, so if the issuer is late in responding and so on, it's going to take longer. Okay. Always be prepared with updated financials to weather the stale aspect, because 135 days financials go stale. Back to my point earlier, be prepared from a financial operations standpoint and have your team in place so that you don't have that holding up the process. The Division of Corporate Finance is focused disclosures not to opine. They're not going to opine on the deal. There's a political climate here. We have someone on our staff was with CorpFin for about 7 years, and the political climate with the Trump administration, and actually goes back to the Obama administration, the Trump administration, was such that they did not comment on anything that didn't have accounting guidance behind it, and they didn't have subjectivity in their comments. In other words, they didn't opine it just as a matter of without a basis. And now that's changed under the Biden administration. They actually have a quota on comments, which means that you could get subjective comments that aren't necessarily founded on some accounting codification. Okay. I think that's why he left. Didn't really enjoy that part of the process there because that caused more complexity for issuers and it stifles capital formation. All right. National exchanges, SRO, self-regulatory organizations, SROs. Joe earlier had a great presentation with respect to the depth in this, so I'll cover it briefly here, but just in terms of awareness, so of all the factors, SROs manage the process within them as a respective entities. You know, self-regulatory organizations. OTC Markets is not an SRO, okay? And then you have SIBO, which is new, which is terrific, and they're here. I recommend talking to them, which is causing disruption because it's a new venue and a new exchange. So basically an SRO can handle soup to nuts. It doesn't go through the process of 15C, or I'll cover that in a second. A 211 process is what they do directly as a national exchange. Okay. So just some factors here for the NASDAQ listing agreement, all electronic. These are their market tiers and in order of increasing higher standards. They both have quantitative and qualitative requirements in terms of reviewing public information, i.e. they want to ask something about a shareholder on the shareholder list, bad actors and so on. not really a quantitative measure, but they'll look at that to see, you know, who constitutes that cap table, because they want to know everything about the company besides its numbers and so on, but who's actually constitutes selling shareholders, what have you, very important factor. And there are initial and continued listing requirements. So it's pretty spelled out when you go, there's links I provided here where you can look at the listing requirements and so on, but the continued listing, it's spelled out as well, but there's some things that aren't. For example, you have to be able to, you know, technically you're supposed to notify the NASDAQ within, 15 minutes, generally speaking, before you have an announcement. A lot of companies don't do that. So you have to have, you know, counsel can guide you on that and so on. You got to have a, you know, there's no rule book either on that. So you have to be able to, you know, follow best practices. More on NASDAQ here, corporate governance requirements. Again, these are built on the heels of what the SEC requirements are, and they're much more diverse and actually expanded here. They have their own requirements on corporate governance. This is new here on board diversity, okay? So again, the platform of the SEC in terms of their requirements is one thing, but you got to look and turn to the exchanges as far as what their requirements are and what you have to abide by for corporate governance. Other factors, these all deal with what I said before about what the nature of the shareholders are and exactly what, you know, who constitutes the shareholder base. Application fees, this is important here to have, you know, projections with respect to burn rate calculations. That was mentioned earlier in the presentation as well, to know that you're going to meet the minimum shareholder equity requirement, okay? And then last, just as before I head into some things about 15C211, there's seasoning rules for companies that are already traded and they're on an OTC. There is certain requirements for them to be able to list, if you will, so that they can actually be eligible on a national exchange. Again, two totally different things. You have a national exchange and then you have the OTC under 15C211, so of the rules of FINRA. So the pathway is completely different, okay? OTC markets, this is an incredibly robust area, and they operate the regulated of over, these aren't what I referred to earlier on the 5,000. There's only 12,000 U.S. and international securities in these markets. So there's data on over 17,000. I mean, you go to their site, you can do pivots, you can look at, you can filter it. It's an incredible site with respect to information with regard to the whole OTC market. They've got the QX Best, QB, Pink, and eligibility application requires different for each tier. Again, 15C211 only applies to OTC securities, and they may perform an initial review for certain qualified issuers that they do, okay? And again, they're not an SRO. FINRA has a role here, okay? And they're different with national exchanges like I mentioned earlier, okay? They govern the 15C211 process that requires specific information disclosure submitted to FINRA, okay? And Canadian filers, there's some, you know, good, you know, filings on CEDAR obviously can be leveraged with these exchange traded entities for make the process more efficient. Again, if majority of assets, same qualification too with respect to FPI requirements. The majority of these assets and shareholders in the U.S., they may deem to be a domestic issuer. OTC Pink requirement is the most lenient. Most recent annual report with 2-year comparative financial and any subsequent quarterly reports. So the audited statements are needed for the QB and for QX, okay? And financial reports must be prepared according to U.S. GAAP or IFRS, but are not required to be audited for Pinks, okay? Bottom line is full disclosure, okay? 15C211 says you got to have current market information on hand or else you're not going to be quoted. You will get kicked off, and it's very difficult to get your 211. Standard documentation here is what any company, but here is, again, back to cap tables. We had a client that had a guy named Jason P, okay? And Jason P, the FINRA asked a question about, is this the same Jason P in the UK that got arrested for drug dealing and was put in jail? And he says, I'm not the same Jason P. First of all, I'm 10 years younger than that guy. So they're looking at this stuff. Okay. So very interesting. And you look at all of these capitalization, just look at all these. These are all evidencing, they want to know about the equity. They want to know where the dilution is. They want to know where all this is so that the entity can, you know, they know what constitutes that cap table. Okay. Because as much as anybody may be a capitalist and opposed to regulation, regulating this, I think, is very important because we want to protect cap tables. It just destroys everything when something's lurking in there that no one expects, okay? So look at this. Details of private offerings included, who solicited investors, how they are known. Got to know who these people are. Okay, documentation is very heavy on this, Okay. More on just disclosures, continue, docket whether person, see, it goes on and on. So the cap table is highly scrutinized, both quantitatively and quantitatively, okay? So quantitative and qualitatively, okay? So you have to have a Glendale Securities this year. They can tell you much more and much smarter than I am about this, but they can submit the application for you. It takes 3 to 4 months, in some cases up to a year. New issuers, because you have clean cap tabling, some good information, much quicker, not including turnaround time from the issuer. And once they're satisfied, then they can clear on that. And then of course, there's the continued compliance on OTC markets that you have, which gets back to the tiers we had, depending on what tier you're on, okay? Areas of focus, scrutiny, and delay. Again, historical cap table, what makes that up? What are all the securities that potentially affecting this company with regard to what can impact dilution on the cap table? And, you know, derivative securities, variable rate financing, that's all a big deal, okay? So pro forma dilution cap, that's the requirement where you have to show sort of what is the effect of what, like if you're doing an S1, what is the pro forma effect so you can see how it's going to affect shareholder equity, okay? Cheap stock, someone who got stock at par value that's now coming in and they've got stock at, you know, a penny while someone's buying into an offering at $4. It's a big deal, okay? And they'll ask, SEC will ask a lot of questions on that because they want to understand that. And also a progression of valuation, right? So, you know, if you have a deal where, you know, you've priced your last offering at, $2 and all of a sudden you did a down round at somebody at 50 cents, you're going to have to explain that. So the progression of valuation is actually very important in the deal as well. Sometimes that can't be achieved because there is a down round there, but the cheap stock is bad actors. I mentioned about Jason P. Fortunately, he wasn't a bad actor. That was somebody else. Okay. In these complicated finance transactions and business combinations, so these type of things, like I mentioned earlier, you know, have mapped out and accounted for any of these complicated transactions so that it doesn't hold up the audit and so on, and the auditor is able to maintain their independence and so that they can rely on the company and or its consultant to be able to put that together. Disclosures on liquidity and management plans for capital is an area that we see a lot with registration statements, okay? Deficiency in the financial close process and inability to prepare compliant in a timely manner gets back to staleness and so on. And again, stale periods, which we talked about, okay? So timeline, just in conclusion here. So pre-IPO prep, budgeting, investment banker selection, governance, audit planning. I put month 0 because nothing really can really start on this timeline until you know that you have an idea of when your audit's going to be completed, right? Because if not, then you're just, you know, everybody's gathering and expecting to participate in this. Bankers are having calls and no one really knows when the audit's going to be done. As soon as that is determined, then the F1, S1 prep can start in months 1 through 4. You know, that can do sooner, but there's a range. Then the SEC filing and comment process start once audit is completed. So yeah, the SEC filing can be drafted. That's why I have 2 concurrent processes here going on. You can actually start the filing and the exchange application at the same time, but you can't actually file and so on until the audit's complete. Again, with a DRS, you can leave some sections blank, but you still have to have the audit complete on the annual financial statements. Okay, and then clear SEC comments between months 7 through 8, and clear national exchange code. So those are 2 concurrent processes as well that can occur. And then of course effectiveness and pricing. So I have basically a 9-month. Seems like, wow, that's a long time. But you know, how could that be shaved? A lot of it revolves around the audit time frame. Okay, so because with concurrent processes in place, the audit timeline can be, depending how efficient it is, can be shorter, long, or whatever, or can drag down even longer. Now, of course, this is all capital markets aside and everything. Of course, that's a driving factor. But and then my contact information and so on. And then here's the back of my presentation everybody has in their packet. These are links to the particular references. These are great links. Look at stock analysis, look at OTC markets, check out what there's a wealth of information there. Listing center, listing, continued listing, and also initial listing, sec.gov. So great resources. Okay, questions? Do you have to pay? I'm sorry, you say, I think there's 2 questions there. You say, how did they catch the guy? Yeah. I mean, they eventually you build a house of cards to the point where it's with that amount of money, you know, eventually it comes crumbling down. So it was imminent. It was imminent, right? Yeah. So as far as paying capital, yeah, I mean, well, assuming you report it, right? But assuming any gains you have in any type of asset or any type of security, you know, you're going to have a capital gain on your realization of any capital you make out of that. So, I mean, there's some different tax rules that apply, but generally speaking, that's the bright line rule to go by. Okay, yeah, you can't build an entity like that and have that kind of house of cards and that kind of money unless if it's not run, you know, properly without something, I think, caving at some way. That's what was mounting against him. Yeah. So, okay. Next.